Imagine two countries. Same population. Same GDP. Same debt-to-GDP ratio. One of them borrows money at 3% interest. The other borrows at 14%. Same numbers. Completely different outcomes. One country builds infrastructure, funds its hospitals, services its debt comfortably, and still has room to run a deficit when times get hard. The other spends nearly a third of its entire government budget just paying interest on money it already borrowed. It has nothing left for hospitals. Nothing left for infrastructure. It goes back to the market, hat in hand, to borrow more, at even higher rates, because now it looks desperate. This is not a hypothetical. This is the actual fiscal reality of dozens of countries right now. And the thing that separates them isn't their economy. It isn't their government. It isn't even their debt. It's a number generated by a private company that most people have never heard of. The global sovereign debt market, the market where governments borrow money by issuing bonds, is worth roughly $130 trillion. It is the largest, deepest financial market on Earth. It dwarfs the stock market. It moves slower and quieter, but its decisions affect every public service, every tax rate, every infrastructure project, and every crisis response that any government anywhere attempts to fund. And access to that market, the price at which a country can borrow, is substantially determined by three private firms headquartered in the United States: Moody's, S&P Global, Fitch Ratings. Together they control somewhere between 90 and 95% of the global credit rating market. They are not elected. They are not international institutions. They are, structurally, private businesses that charge the entities they rate for the service of being rated, a conflict of interest so fundamental that it's almost impressive it survived 2008, during which those same agencies rated enormous pools of fraudulent mortgage debt as AAA. They survived. Their market share barely moved. And today, their assessments remain among the most consequential documents in global finance. Here is how the system actually works. When a government wants to borrow money, it issues bonds, essentially IOUs that promise to pay back the principal plus interest over a fixed period. Investors buy those bonds. Pension funds, sovereign wealth funds, insurance companies, asset managers. The interest rate the government has to offer to attract buyers is called the yield. The lower the perceived risk, the lower the yield. The higher the perceived risk, the higher the yield the government has to promise to get anyone to buy. Credit rating agencies exist, in theory, to assess that risk. They look at a country's economic fundamentals, GDP growth, inflation, debt levels, current account balance, political stability, institutional quality, and produce a rating. AAA means essentially zero default risk. Anything below BBB- in S&P's scale is classified as speculative grade, junk. And many institutional investors, pension funds, insurance companies, regulated asset managers, are legally prohibited from holding junk-rated debt. So when a country gets downgraded below investment grade, those investors don't choose to sell. They are required to. Immediately. Which floods the market with the country's bonds, collapses their price, and forces the yield, the interest rate, sharply upward. The rating doesn't just reflect the risk. It creates it. This is the mechanic that most coverage of sovereign debt quietly skips over. A credit rating is supposed to be a neutral assessment of existing conditions. But because so much institutional capital is legally tied to rating thresholds, a downgrade becomes a self-fulfilling prophecy. Investors sell. Yields rise. The cost of borrowing increases. The country's fiscal position deteriorates. Which makes the next rating review look worse. Which risks another downgrade. The rating agencies didn't design this loop. But they sit at the center of it. And when they move, markets move with them, regardless of whether the underlying economic reality changed overnight or not. In 2011, S&P downgraded U.S. government debt from AAA to AA+. It was the first downgrade in American history. The stated reason was political dysfunction around the debt ceiling negotiation. The actual fiscal position of the United States had not materially changed in the days surrounding the decision. And yet global markets responded as though it had. Yields on Treasury bonds, which logically should have risen if the U.S. was now riskier, actually fell, because panicked investors fled into the safest asset they could find. Which was, ironically, U.S. Treasury bonds. The downgrade of the safest asset in the world made people buy more of it. The system sometimes produces outcomes that are almost too absurd to model. For developed economies with deep domestic financial markets, strong institutions, and currencies they control, a rating downgrade is painful but manageable. The United States, the United Kingdom, Japan, these countries have enough structural credibility that the market gives them enormous latitude. For smaller economies, emerging markets, or countries that borrow in foreign currencies rather than their own, The calculus is brutally different. A one-notch downgrade can add hundreds of basis points to borrowing costs overnight. A two-notch downgrade can effectively lock a country out of international capital markets entirely, forcing it toward the IMF, toward emergency austerity, toward the kind of fiscal compression that guts public services for years. Ghana, Sri Lanka, Argentina, Zambia. Countries whose crises looked, from the outside, like failures of governance or economic mismanagement. And sometimes they were. But sometimes the spiral began with a rating action, taken by a private firm, using models that weighted market sentiment as heavily as structural fundamentals, and the downgrade made the crisis it was predicting. There is no international appeals process for a sovereign credit rating. There is no oversight body. There is no mechanism for a country to formally contest a methodology it believes is flawed. There is, in effect, no recourse. 3 private companies, operating under U.S. law, applying frameworks developed primarily in the context of Western financial markets, issue assessments that can determine whether a developing country's children have functioning hospitals or not. And the countries most affected by those assessments, the ones with the least structural credibility, the most dollar-denominated debt, the thinnest domestic investor base, are also the ones with the least power to push back. So the next time a country announces it's cutting healthcare spending, or raising taxes, or accepting an IMF program with conditions attached, it's worth asking one question before reaching for the obvious explanation. Who changed the rating? And why did it move when it did? Because somewhere upstream of that austerity budget, there is a spreadsheet. And the people who built it don't answer to anyone you voted for.